growth.
Next one for you, Jason. China is reportedly telling companies to avoid Nvidia's H2O chips after Trump resumes sales. I mean, how can America make sure we're the leader in the global AI race with China in mind?
Well, I think it's by doing exactly what President Trump did. And this is an interesting angle here. China saying that Chinese companies shouldn't buy these U.S. chips. Even the Chinese government recognizes that American manufactured chips are the best in the world, which is why they're making this announcement that maybe Chinese companies should buy Chinese chips instead. Look, President Trump's strategy here is clear, and the tech industry embraces it. We want the world to adopt American technology. So the answer to the question, how does America win the global AI race? We ensure that countries around the world can buy American AI technology, including semiconductors. China's going to do it. The president has cleared the way for that to happen. And that ensures that the rest of the world invests in the American AI stack, if you will, from chips to data centers to servers and everything else. That's what we want to see happen.
You're taking a look at the chip makers, all in the red.
Yeah, they're all down today. Not a great day for chip makers. President Trump says he's going to be setting a tariff on semiconductors next week or the week after that. And you see the stocks already moving. He's threatening up to 300% massive duty for those companies to take on.
Earlier this year, Nvidia's stock saw a sharp decline due to concerns about Chinese competition and tariffs. Growing infrastructure expenditures by its biggest clients indicate that demand for artificial intelligence, AI, is still high. The share price may not yet completely represent emerging AI potential, despite a robust recovery over the past few months, according to valuation trends. For Nvidia's shareholders, this year has been an emotional roller coaster. The company's shares fell as much as 30% earlier this year, with the announcement of higher tariffs and increased competition in China, wiping off around $1 trillion in market value. Although such sharp drops would have implied that Nvidia's heyday was over, the stock's more recent performance contradicts this. It is now the most valuable firm in the world, with a market valuation of $4.4 trillion as of August 7, having recovered 93% from its 2025 lows. Is it too late to invest in Nvidia now that the stock is reaching all-time highs due to such tremendous momentum? Let's investigate. The computer and networking division of Nvidia is the company's biggest income generator. This category includes the company's highly sought-after graphics processing units, GPUs, and data center services. Spending on artificial intelligence, AI, is a good indicator of the company's health. Capital expenditures for cloud hyperscalers. Amazon, Microsoft, and Alphabet, as well as social networking startup Meta platforms, during the past 3 years are depicted in the chart below. These Magnificent Seven businesses demonstrate how Nvidia's semiconductor company might benefit greatly from rising investments in AI infrastructure. The growing use of cloud infrastructure services from Oracle and neocloud platforms like Nebius Group and CoreWeave, in addition to the typical suspects of tech giants, provides another source of demand for GPUs, particularly for Nvidia's most recent Blackwell architecture. Neoclouds are becoming more and more popular right now because they provide cloud-based infrastructures for access to GPU clusters and adaptable software-hardware stacks in the form of high-performance computing, HPC services. Investors have heard analysts talk about the significance of data centers in advancing the development of generative AI on numerous occasions in recent years. This is true, but I believe that many investors are failing to see the bigger picture in terms of how AI infrastructure spending has changed over time. Advanced workloads in robotics, autonomous driving, and quantum computing are part of a new stage of AI usage. While Amazon, Microsoft, and Alphabet are all creating their own unique quantum computing processors, companies like Tesla and Alphabet are starting to make money off of their driverless cars. Nvidia is only now beginning to expand its CUDA software platform and hardware to take advantage of these new prospects. I'm confident that the company's product suite will continue to play a significant role in the creation of more sophisticated AI in the future, especially given its current strong integration with big tech. The company's forward price-to-earnings (PE) multiple during the AI revolution is depicted in the chart below. The forward PE range of 24 to 30 might be viewed as a support zone or valuation floor for Nvidia given the previously mentioned patterns. The stock has always recovered well after its forward PE fell into this region. This implies, in my opinion, that despite sporadic, brief episodes of negative mood, investors continue to envision strong long-term growth for the business. These patterns in valuation, in my opinion, suggests that the market may be underestimating the extent of Nvidia's pervasive platform. Many investors still only see the company as a semiconductor company, even if it has a significant impact on AI infrastructure. I believe the stock is poised for a sustained breakout when these new opportunities materialize, akin to the initial surge of AI-driven excitement a few years ago. I believe there is a strong argument to be made that the company is positioned for future valuation expansion and might reach or surpass historical levels, even though its forward PE is rapidly approaching previous highs. According to my reasoning, investors have not yet properly priced into the stock the monetization potential of upcoming prospects in robots, driverless vehicles, and quantum computing. The stock may surge beyond $200 and approach $220 by the end of the year if Nvidia's current future PE grows to levels consistent with previous highs, which would indicate a 10%-20% gain over current price levels. Because of this, I believe that by the end of the year, Nvidia's stock will be trading much higher than it is now. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video. Nvidia's explosive growth is a market story as well as a stock story. Because of its size, Nvidia can significantly increase the S&P 500 or the Nasdaq Composite on its own. Gaining close to $500 billion in market value is like constructing a firm the size of Netflix out of thin air, which is saying something, since Netflix is the 16th largest S&P 500 component by market cap. Wider market gains follow Nvidia and its mega-cap counterparts. Here's why I firmly believe the market valuation of the growth stock will exceed $5 trillion, and why Nvidia has a well-defined path to success in the future. Nvidia's market worth was less than $500 billion 3 years ago. To become the most valuable business in the world, Nvidia had to rise above $4 trillion in market capitalization through a combination of investor optimism, profit growth, and the emergence of a new era in artificial intelligence (AI). However, Nvidia will have an easier time getting to $5 trillion and beyond. While there is just a 25% rise from $4 trillion to $5 trillion, there is an eightfold gain from $0.5 trillion to $4 trillion. On a percentage level, it's not asking for much over a few years, but it's an unparalleled amount of value creation. Investors might be less inclined to pay such a high price for the stock, though, if Nvidia's earnings growth rate slows. At 58, Nvidia's price-to-earnings ratio is significantly higher than that of the majority of its mega-cap competitors. However, Nvidia can support that price since its earnings are expanding at a far higher rate. However, if Nvidia were to slow down to levels of a company like Microsoft, which has achieved 15% revenue growth over the last few years, with net profit margins around 36%, then Nvidia's valuation could compress. Even if the stock's PE declines and its profits growth rate slows, it may still be a great investment and continue to reach market cap milestones. The more important question, though, is where the money will come from. The fact that Nvidia's clients include some of the top businesses in the world is arguably the most straightforward explanation for the company's sustained growth over time. Nvidia usually includes a section titled Concentration of Revenue in its quarterly 10-Q filings. Sales to one direct client, Client A, were for 16% of overall revenue for the quarter, according to Nvidia's most recent 10-Q dated May, the first quarter of its fiscal 2026. Sales to a fourth direct customer were 11%, sales to customer B were 14%, and sales to a third direct customer were 13%. Nvidia's compute and networking segment, which mainly consists of high-performance graphics processing units, GPUs, for data centers and related hardware and software to manage AI workloads, such as devices that link GPUs together and facilitate system communication, was responsible for the revenue generated by all four customers. These clients collectively accounted for an astounding 54% of total quarterly revenue. Although Nvidia does not specifically identify these clients, it is quite probable that they are Amazon, Microsoft, Alphabet, and Meta platforms, all of which rely on Nvidia processors to run their AI infrastructure, services, and data centers. Aside from these big four, several other businesses like Oracle through Oracle Cloud Infrastructure are quickly pursuing cloud and AI goals. Tesla uses Nvidia's GPUs in its autonomous driving models, making it a major customer. Through the Microsoft Azure OpenAI service, a platform for utilizing and creating OpenAI models, OpenAI is also a significant indirect customer of Nvidia. Revenue concentration is typically a warning sign since it indicates that one or two clients could negatively impact outcomes if they reduce their expenditure. However, it may work to Nvidia's advantage because its best clients have outstanding balance sheets, rising profits, and plenty of free cash flow. To put it another way, they have the means and avenues for innovation to gradually increase their expenditures over time, which will help Nvidia's profits rise. Now that it is around the $4.5 trillion mark, Nvidia's path to $5 trillion in market capitalization will be simpler on a percentage basis. Nvidia's top clients must, however, receive a respectable return on their investments if the company is to remain a profitable stock. To put it another way, Nvidia needs to be at the forefront of the AI market's growth from a computing and networking perspective. As a result, investors in Nvidia might want to think about making the connections by listening to what its major clients have to say in their quarterly results and investor presentations. Nvidia stands to gain if they maintain their enthusiasm for AI and keep increasing their funding for it. However, if the spending cycle shifts from expansion to downturn, Nvidia's stock price and earnings could suffer significantly. Analysts at Macquarie say Beijing's long-term artificial intelligence policy is unlikely to change if Nvidia's H20 AI chip shipments to China resume. The action is still controversial, even though Macquarie stated that it marks a turning point in U.S.-China trade talks. According to the analysts, U.S. lawmakers and political organizations are unhappy that the Trump administration is sacrificing national security for financial gain, while Chinese regulators seem to be resisting the use of H20. According to Macquarie, the H20 is more of a short-term fix for China to meet the need for AI inference. The long-term objective is still to develop an end-to-end AI ecosystem domestically. According to Macquarie, recent announcements demonstrate a fundamentally different strategy between the two nations for assuming leadership in global AI. The U.S. strategy is inward-looking and focuses on exporting full-stack AI solutions that are centered in the United States while also developing domestic infrastructure. China's plan, on the other hand, focuses on cross-border open-source development and adopts a multilateral strategy to assist emerging markets in closing the digital divide. Despite having access to Nvidia processors, Macquarie predicted that China will likely keep making significant expenditures in its cutting-edge semiconductor ecosystem. With solar companies that have no bearing on the rise of AI, the MSCI China Semiconductors Ahead PEE of 65x trades at a more than 2.5x premium to the SOX index. Rather than conventional manufacturing or packaging, Macquarie believes that optical components like InnoLight and IC design like Cambricon have the highest AI beta. The analysts consider internet data center proxies like Alibaba to be attractive in terms of quality and risk-reward among more general investments. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Now, let me get your take on this new report claiming that U.S. authorities have been secretly placing tracking devices in targeted shipments of advanced chips, detecting if chips are being diverted to destinations under U.S. export restrictions like China. That is why the president has put these transshipment costs on other countries. China told its companies to avoid using Nvidia and AMD chips after the White House announced both chip makers will give 15% of China revenues to the United States. I asked Treasury Secretary Scott Bessent about it yesterday. Here's what he said.
We're allowing the sale of the Nvidia H20s. I'm not sure what the comparable chip is for AMD, and that's about 5 levels down the Nvidia tech stack. And now the Chinese don't want their companies to buy them, because our rationale for allowing this, other than taking in revenue for Treasury for this strategic industry, was to make U.S. chip makers the global standard. Now the Chinese are looking at this for a minute and saying, whoa, we don't want Nvidia to become the Chinese standard. But we're also seeing today that the Chinese AI company DeepSeek is having trouble going to the next level using Huawei chips. So they've kind of backed themselves into a corner. They don't want to have a U.S. standard, but their domestic supplier seems to be subpar.
What's your take on this, Gordon? I mean, this is pretty extraordinary that the president and the administration has been able to negotiate NVIDIA and AMD paying 15% of their revenue from chip sales to China to the U.S. government.
Yeah, I don't think that the U.S. government should be taking a portion of the revenue from this. We have taxes, and that's net income. I'm worried about the potential for abuse, but also I don't think that we should be selling the H20 and the MI308 to China. And this actually gives the federal government an incentive to approve those sales. Also, we're now hearing the Trump administration talk about selling a more advanced chip, more advanced than the H20 to China, based on their Blackwell design. So this is not going in the right direction. Treasury Secretary Bessent was absolutely right. The Chinese may say they don't want Chinese companies to buy the H20, but it really wants them to, because as we saw yesterday from the DeepSeek, they can't use Huawei's Ascend chip to do what they need to do to get their model out into the public.
Yeah, it's a great point. There's so many ways to look at this. I mean, on the one hand, maybe that is propaganda coming out of the CCP. Oh, yeah, don't buy these chips. Don't use these chips. Meanwhile, it's the best chip that you can use and the most advanced that the U.S. military uses. Mark Tepper, I also find it fascinating that they have negotiated this deal to send 15% of the revenue that they're making in China to the U.S. government.
Yeah, I know. It's interesting, but if I'm looking at it from the perspective of NVIDIA and AMD, you've got two options. You pay 15% or you can't export any of those chips at all. So I guess it makes sense why they are willing to make this deal. But to Gordon's point, I've never been a fan of the government getting too involved with any private enterprises, whether it's the U.S. government potentially taking a stake in Intel or bailing out the banks during the Great Recession. I've never been a big fan of that.
Yeah.
I always want private enterprise to do what private enterprise does best, and that's go out, pursue profits, try to improve shareholder value and things along those lines. That's when capitalism really works at its best.
So you don't like the idea then that the talk is that the government's going to take a stake in Intel?
No, I'm not a big fan of that at all. I don't know how it would work. Not a fan. I mean, just look at, under President Biden's watch, we gave Intel billions of dollars, and they immediately responded by slashing headcount and firing employees.
Yeah.
I don't want my tax dollars owning any of Intel, to be completely frank.
Well, I mean, that was one of the reasons Tom Cotton sent the letter to the board of Intel in the first place. Intel was given all this money, and yet we see all these reports that the CEO, who used to be the CEO of Cadence, was actually doing deals with, and selling secrets to Chinese military companies. That was why the senator sent the letter. But Gordon, real quick on the macro story here, because we've got new data on China's economy. The Wall Street Journal writes it's a broad-based slowdown last month, adding to the pressure on Beijing to do more to rev up growth. How would you assess the economy of the second largest?
Yeah, these numbers from July showing growth slumping are really depressing for China. And yes, the tariff war has had some effect on it, but primarily it's because the domestic economy is probably about zero if the Chinese were actually honest about their statistics. We're seeing price data which shows deflation, not only in the factory sector, but in the consumer sector as well. And that means there can't be that 5.2% growth that they reported for Q2. So China's economy is at a point where even without the tariff problems, it just can't rescue itself. The Communist Party can't make those decisions to rescue the Chinese economy.
And we should point out that China held back from doing any new stimulus in the month of July. So it's questionable whether or not this economy in China actually is, growing without the government's help, without the stimulus. Because look what happened in July when they didn't